Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Monday, May 6, 2024. It is 10:47 Eastern Time. So I'm starting the video, and I wanted to get one out, and here's what we're going to do in this one. We're going to cover the main asset classes, and in those, they've all either are currently trade ideas or in the case of treasuries, and some others were recently. And so what we're going to do in this order, start out with stocks, really the stock market or equities, one asset class. Quick touch on bonds. Told you personally, I closed out that treasury bond, 30-year treasury bond hedge on Friday, and I'll just talk on that real quick. Commodities, definitely want to get into that. Been highlighting the grains recently, natural gas, and then as of Friday, started warming up to crude as well. Bitcoin, I'll touch on it. I threw it out a week or two ago. It looked good at support with a divergent low, and it's rallied. I want to show you where it's at now. There's some technical developments to note. Time permitting, I'll touch on gold, silver, and the mining stocks. I told you it's just kind of a grind trade, one that I'm not really that interested in right now, but I'll give updates because I know there's always comments and questions on it. And then I definitely want to get to the euro US dollar. I know most of you don't trade forex. I'm going to be pretty confident in that. However, I like to incorporate it into my analysis. I haven't covered it much lately, but there's some developments worth noting today. And again, whether you trade it or not, these developments are also germane to the stock market. So we'll get to that in kind of that order. So I probably couldn't have been any more clear and consistent on my trading plan recently. You had this trading range here, very well-defined QQQ, very clear breakdown. Went through the first target as expected, didn't have very little reaction around there, but we definitely had a reaction off T2. Hit that bounce. By the way, I just got a price alert on wheat. Looks like we hit the next target. I'll get to that in a second, but my alert just went off. And then, game the bounce there off T2. But we're back into what I call no man's land. We shouldn't have gone back into that. That's not a healthy development. So I was very clear that, to me at least, and kind of recommended based on the whole breakdown here, that's the no-go level. There's only two trades or one trade to be made right now, in my opinion. Other than if you want to, scale out or close out a short trade completely on QQQ, if you did scale back in or rode out the bounce. The only trade today, other than that, is to go long because we regained 433. So that means this was a break of support, a back test, a rejection, but now we took back support. I am not doing that. I'm sitting tight. I want to see what happens at the end of the day. I've been, as told you, up until Friday, completely hedged, and that hedge more than offset the give back. Now remember, again, I gamed it down while I was long, half the bounce up, then started shorting back, and then on Friday removed that hedge against the index shorts. But then I'm going to speak on the benefits of diversification. Every other thing I have, all the other asset classes. The grains are ripping today. Natural gas continues to do well, and crude is even up again today. And that's the one I mentioned on Friday, taking starter position on. All right, so that's it. So we're not going to go too deep into it. There is a downtrend line that comes into play, and we're a little bit above that. But the way this works is, look, the longer you stay up here, and if you close up here, comfortably above the level. I said on Friday it was close, very close. You'd have to squint. We were technically above it. And again, that's kind of, even though NQ is closer to the bottom of its trading range, I still maintain that I would not personally short QQQ or add to any shorts or take a short, open one up, or put one back if you're not in it, or if you stopped out until unless we fall back below 433. And then look, you have the 50-day just below it. So the 50-day axis support, it was taken out there. We back tested it there on 3 different days. When we were back testing 433, got rejected, so we're above that. So there's no way that I can see right now as a spin today's price action as anything but bullish. Okay, and so if you are going to go long, then the same thing. If you see a failure, will the real whipsaw step forward or raise its hand? That's what we've seen here. It's been a very, very choppy market around earnings, and so if you are long, I wouldn't put a stop at 429.99, or 431.99. I'd have it a little bit below. There's a big old gap back there. So the bottom line is you're going to need to swing trade the equities right now. You're going to need to use a little bit wider stops, in my opinion, because the market's been whippy, slicing through key moving averages, key support and resistance levels. And that's that. Enough on that, really, I think. But I just wanted to make it clear. And then just to kind of update the NQ, these are the NASDAQ 100 futures. And in case you missed it last week or last few weeks, this is the comparable level right here. The line I have is at 18,046. And we're a little bit above that now. And you still have, by the skin of its teeth, but it's still there, divergence here on the 60-minute chart. And so that indicates to me that this could be, again, you can trade either on if you're using a 60-minute time frame, you can wait for the 60-minute candle close above. You can also wait for a daily time close above. The only problem with using that for your stops is you could continue to build on these gains. By the end of the day, you could be up here somewhere. And there's that downtrend line, very, very well defined. So like I said, we're only relatively slightly inside, but we are above it. So it's kind of a no-go thing there. And again, this is comparable to the 433 level on QQQ. So that's where if this little thing proves to be the whipsaw and it's just simply a back test and a rejection, then you can always get back in or add to. Or if you're riding it out, like I said, you really want to start being concerned if this downtrend line's taken out. We get some momentum. But I'm going to go over a few other things to watch that tend to impact the market. All right, I already took quite a bit of time this morning. It took a while to mark up all those charts, but I gave you the top, I think it was the top 7 components of the NASDAQ 100. Most of those are the top components of the S&P. So you have detailed levels to watch on those, key support, resistance levels, moving averages, trading range. Remember my purple and yellow key support levels, quite a few that, about half were taken out in the fangs. The other half didn't take them out. It's the same story we've had all year, just a handful, and even fewer stocks doing the heavy lifting. Let's not forget, we're still well off the highs right now, not by a huge percent, but when you look at this 60-minute chart, we're just only punching through the bottom of the trading range. So I have not given up on those deeper targets being hit. Like I said, it's about managing positions. You got to wait just a little bit. And if you just wait, for a little bit more downside, all we have to do to get back here, let me go back to QQQ. All we have to do to get to 433 literally is drop 1% or 1% above 433. So it's nothing right now. I think anything probably more than a punch through. So why, what's the benefit of shorting here? Again, I'm talking if you were blank slate, had nothing, versus just waiting for that failure, and then this will be become a nice stop clearing move, bull trap, and all that. Because again, I think a lot of eyes seen 433, even though I was talking about back here as a big level, and then we had multiple other tests, and then once it broke, we had the impulsive rejection, and then another rejection. So on a scale 1 to 10, that's close to a 10, is a very obvious and visible and key support and resistance level, and so that's that. Now we will get away from it, and I'll move to the next one. I don't want to spend a lot of time. TLT was ZB was my my preferred trading proxy, but TLT is the ETF. I threw it out there to you the other day. It happened to be literally at the very tick of the lows on ZB was the chart I gave you, and then sold it Friday at the high. So like I said, I covered that on Friday. It actually outperformed from where, and again, remember, I was long the first part of the T2. It was only the second half where I scaled back into those index shorts, and then got in here, and so that was actually more gains netted out in the ZB/TLT long than give back in or drawdowns in reshorting the Qs. Now, again, I'm what I call raw dogging the Qs now without any direct hedges, but I'm going to get to the next things in a second. Still very diversified, and everything else is firing on all other cylinders. This is the one cylinder right now. It's not. I'm talking QQQ, not TLT. I'm out of that. And again, if you were in it, if you took it, like I said, a pretty good case here to be made. divergent low. And I told you before, there's, I think, a decent chance we're going to go up there. And I may re-enter it. I just, right now, like I said, I'm comfortable being out. And if we do go up there, that's also going to mean yields are falling. And that should be, again, I have to use my little parentheses fingers, little quote, putting quotes unquote, should be net bullish for the stock market because rates will be going down. The only way it's not is if the markets suddenly turn around, take a dive, take out 433, start moving impulsively lower, and you see a flight to safety bid, where bond prices, institutions are moving into bonds, which is then making rates go down. And that in itself, if that's the reason, a flight to safety bid, that's not bullish for equities. It's the opposite. However, if natural organic market forces bring interest rates down, which make treasury prices go up, that should be net bullish for the stock market and could help support a rally back up to and above the recent highs in the market. So we'll continue to watch this. Like I said, I just felt better to me to get out. It served its purpose for what I took it for, the hedge part. And if you're trading it either still you're hedging up or using it as a pure play, I would watch that level. I think any rally into that downtrend line is most likely going to at least give you a tradable pullback, and so a good place to book profits if you're still long treasuries. Okay, let's talk commodities now. That's started with wheat and corn a few weeks back. Wheat, I told you, I just had a price alert go off as I started this video, which is right here. And that's, I guess it's the old T1, which we already hit back here. Oh, it was right there. We hit it again, but actually took it out. See, so if you remember, we hit it the other day. Right when we hit it, I gave you a little chart update with a pullback arrow, and then we go up through there. The fact we already hit it once increases the odds. Now we're going to go on through it. And so, as I told you before, I sold it, recycled back in, and, don't plan to sell T1 again, which is at right now. We're at 598. So that should, I think, will open the door most likely here. Seeing building momentum coming into the grains here. Price actions constructive and not much else to add. Nice volume you can see on this ETN. Same with futures. I trade CW wheat futures. And no reason, like I said, to take profits again at T1. The other ones are corn. Again, they're going to move together. I've talked on that quite a bit. Not every day, but corn just hit corn hit it on Friday. I already gave you an update there. And look, now it's taken it out. So remember, that's how this works. Initial tag, you had a little reaction there, and now we take it out, and that should open the door to these next targets up here. You have the downtrend line and 2178 come in roughly together, so you have, what was wheat up today? Let me go back. Wheat's up 1.87 versus, again, if you're diversified, QQQ is only up 0.5%, and so wheat, doing well over almost quadruple that today. And so again, another, the benefits of being diversified, not putting all your eggs in one basket. Corn up 1.56, and then the other one we're in is soybeans. Added that the other day too. ZS is your future symbol, and oh, look at this, we're at T1, close enough. And the futures, I believe, are already at, so I'm going to call that a hit. Remember, you always want to, ideally you want to chart the futures, because when the futures hit resistance, that's often when you're going to get a reaction, or you can just sell a little shy if that's your target. Now, look, if you're keeping your eye on the prize, this is a divergent low, and I've already listed multiple targets, so there's nothing wrong, even if you're going to ride out of bounce, for a typical swing or trend trader to just sit tight right now. Like I said, price action's constructive, and soybeans are up 1.3%. And then we have other commodities too that are completely unrelated to these grains, and that would be UNG or nat gas futures. That one, T2, has been hit today. Oh no, did I already cover it Friday? Was it Friday was hit? Monday, Friday. Either way, I might have updated this today. T2 is now hit, and that opens the door to T3. So far, so good. I got you an update on this earlier today. That's right. 17% or so off the recent lows, and that's where we've been scaling in, buying. Highlighted. That's long-term support as well. This is only a 60-minute chart; doesn't show it. So no, looks good. And remember, you've kind of got this, basing pattern here. We've been kind of grinding around this range. So if we pop T2, it should be, I think, a relatively quick run up to T3, T4, and then I might have some additional targets on those nat gas futures I got out to you. So far so good there. Also up 3.5% right there on NG. I'm sorry, 3.5. Also on the futures, I'm looking at another monitor exactly 3.6% on the futures right now. So again, what is that? 7 times what the Nasdaq's doing today. That's why I'm sitting tight on my QQQ, NQ positions, NQ shorts for now. But like I said, I may throw them away. I'll tell you what, I'll almost certainly throw them away this week if we don't reverse soon. But I'll keep you posted on that. And the other one I mentioned, let me go to the futures here. Yeah, so that's the one I got out to this morning. That's NG right there. T2 being hit. If you're a longer term swinger trend trader, I've shared this chart too. I have this is the same chart, NG, but it's a day 8-hour candles. So 1 year of price history. And it just kind of shows you nice and clean the downtrend line, the big wedge, impulsive breakout. And I don't really on this chart using these 8-hour candles, which are almost daily candles, there's it's kind of pretty smooth sailing, I think, up to that next target there, T3. I don't know what shifted. Why did these lines shift? I think they're carrying through from that 120-minute chart I just showed you. That's what it is. Okay. So, but the lines on that daily or the 8-hour, we'll go back there. The lines on that, the next one there is at about 237 or so, and that should come in 237. Yeah, right here around T3, T4. That's on this 120-minute chart. So this is kind of the official one that I'm using for the trade. We actually started back before the June. We rolled into the Junes. We've been scaling in and buying, highlighting it here, long-term support for a while around that 1925 area. Okay, and then crude oil. Okay, so I highlighted this one on Friday. There's a nice uptrend line that comes in right around, that's about 78. It says 77.98 on my chart here, so we'll call that 78. And that's where I told you I'd start, taking, and that's all I did, a starter position. I'd like to see it get down here, and I'd like to see this divergence kind of firm up a little better looking. But I don't want to also miss it if it reverses, because there has been that negative feedback loop I've talked about between the stock market and inflation, i.e. interest rates. And so every time you get a little market rally, then I notice it's what the institutions are doing. I'm doing the same pattern because it's going to, again, the market doesn't always make sense with the economic numbers. In fact, let me be clear. Last week, we're continuing to see the trend indicators, the economic indicators I follow are painting the same picture. We're already seeing employment slide, and that's always the last pillar. And I've showed you charts. I don't have them queued up in the past. You can do this. Go to macrotrends.net or one of those sites and chart the unemployment, go back long term, and you'll see we always start from the historic lows that we're at. We get down to the low end of the range, and once it turns, it's never kind of a zigzag up. It usually just takes off, unemployment, and it always comes from those Goldilocks conditions where low unemployment. And so I'm seeing that, but yet in the market's seeing it, but yet market's cheering it because it's increasing the odds for a rate. So Powell's going to give us a rate cut this year. I almost guarantee that. Probably a quarter point. We'll see. And if we get anything more than a quarter point, it's because the proverbial shite is hitting the fan. And that's not going to help the market if that's happening. And also remember, too, the other chart I want you to pull, I've covered it in the past, I don't have it queued up. Pull the federal funds rate, the long-term historical chart, and you'll see the same thing. The recessions come only after the end of a rate hiking cycle, right after the Fed starts to cut rates. You'll see that too. If you go to, I think it's macro trends, one of those where you can do the shaded areas and show the recession. So you'll see that too. And it's almost like comical. Like this is a clear pattern. I've showed it before, going back decades. This isn't just a random pick a few data points. Yet the market somehow thinks that's going to be bullish when the Fed goes back to start to cut rates. It's insane because history shows after a rate hiking cycle, they cut rates, then the recession follows, then the stock market goes down. So, but yet they don't talk about that on TV, and it's clear. Again, I don't have it queued up. If you want me to do it, put it something in the comment section. I'll cover it in the next video. I just have to go into and find those charts. All right, so that's it. So this is back to what I was saying is you have crude here. You're at price support now. It's okay. It's decent, not the best. But again, as I said on Friday, that we're only less than 2% to the trend line there. So I think it's time to scale in. You've got some divergences building down here on the indicators, and where to? Probably run up. There's a downtrend line that needs to be checked. And again, it's just the vicious cycle of we see this every time. This is lately crude's been coming down. It was a catalyst for this what I consider counter trend rally that we're in right now. That's taken QQQ back to test the range, the bottom of the range, and it was this crude going up that I talked about that was the reason the range was going to break to the downside, which it did. It was from the last FOMC meeting we had an 8% drop on QQQ from that last short. Well, the short we had after the previous FOMC meeting, we got 8% on that, covered that, came the bounce, took another 2 to 5% depending on how long you milked it up, and so you just got to get in front of this, and what will happen now is because the market's rallying, you'll most likely see crude prices going up, indicating that sure, if everything's doing well, hunky dory. Economy's good, stock market's good, people are going to keep traveling, taking vacations, more planes in the air, more cars on the highway and trucks delivering goods and services, therefore more demand for crude, right? That's kind of the macro, bigger picture, fundamental stuff. And not to mention that, a lot of this drop has just been the, tensions cooling down briefly in the Middle East. But, if you think that's going to last forever, then we'll see. Okay, so a couple weeks ago, I highlighted Bitcoin as looking bullish here. It was at this 50. This is Bitcoin, the actual crypto here. You can trade Bitcoin futures. There's a plethora of ETFs out there now. You can trade, and so we had this, this area of consolidation. It was a support level I had at 57,500-ish right there, and positive divergence and. So far, I'm going to add another trend line right here. I can see potentially forming, coming up to right there. Let's do that. But so far, I have to move here so I don't move. It's nothing huge, about a 13-15% rally off that level. And what we did is we took out this downtrend line I had here from before. We did put in a little divergent high, so pullbacks to be expected. And we're back testing this trend line here. If that we may probably backtest for a while till we come down to this trend line here, and so if you're looking to get into it, that would be an objective level there. You have a gap right there, somewhere in there, and then you have support down here. So there's your support range. You might want to have a stop somewhere in there if you're buying back, or if you took it here, and if you're holding out for more. And then bigger picture, that's kind of smaller picture. Bigger picture is kind of trading around in this range for a while. And so just, if we happen to get to the top of the range, keep in mind that's going to be resistance, quite powerful if it breaks out. The bottom of the range is not as well defined. So you have this previous low. And then if we break that previous low, you have this consolidation area right here, you can see, which is a support zone down below. So there it is. I don't have strong convictions on it right now. It already had a nice 15% pop or so from where it was mentioned a couple weeks ago. But at this point, kind of in no man's land. All right, I'll touch on gold GDX just because I said I would. I'm trying to cover all asset classes. Gold, remember, had a breakout on the daily. It's not shown here. It was about this level. Big rip. I think everybody got too bullish too fast. It was a good technical breakout. But like I said, there were divergences across the board. Too many people getting on the same trade at the same time, and that just, now you've got, well, no, you had some divergence here on the PPO, and you still do, but I don't have divergence on the RSI. And bottom line, we put in a divergent high there. We had the sell signal one. I've covered it quite a bit. We're just zigzagging lower. And, maximum downside, I could see a breakout of the back test. Probably not get that low. Again, it's been a dead money trade for the last few weeks. And so I'm just updating it and telling you I still don't have strong convictions on where it's going. But I suspect this top might be in place for a little while here, is what I suspect. I think it may continue to grind lower. And what may do that? That brings me to the next thing I want to cover. And that is the US dollar and the euro. The euro is the biggest component of the dollar index. So you have this, this is a 60-minute chart. Downtrend line. I've had this downtrend line on the daily for quite some time here. And you have an uptrend line here. Lots of clean reactions. That's what, when I say clean reactions, distinct reactions, to help validate that trend line. I just circled 5 of them. And down here you have quite a few. And this is what we call symmetrical triangle pattern. Now you have to respect whichever way this breaks. Could determine the next trend in the euro and the dollar. On the daily chart, you can see back here, I highlighted this divergent high. We've been stair-stepping lower. And then we took out this trend line off the lows, which was pretty bearish. And we're below that trend line. And this is that same uptrend line I just gave you on that 60-minute chart. And so we're coming up to that, meaning we're coming up to resistance on the euro. And so, but I want to show you something. So the euro, I always talk about the EUR USD. Euro is 57.6% of the dollar index, which is by far the biggest. The next is the yen at like 23.8 or something. And then everything else literally doesn't matter. You can add up the freaking British pound, the freaking Swiss franc. You can put them all in there. And they're not going to move the needle as much because those two alone, the euro at 57.6 and the yen, JPY USD is at 13.6. So that's 70% right there. So everything else collectively is 30. So these are the ones to watch. Been a lot of manipulation in the yen lately. So we're just going to watch the euro. And to do that, let's do this. Let's go to FXE. And like I said, being at 57% weighting, you can see that the dollar, which is UUP, is the ETN for the dollar right here. So this shows you my dollar chart. And then we can look at UDN, which is the inverse dollar. But there it is. We had a downtrend line, breakdown here. I'm sorry, an uptrend line, found this divergent high. This is where the dollar peaked recently, had a nice wedge, negative divergence, broke down, went down here. That's really good support right there, about $27 or so on UUP, the dollar index. Rallied from there, and we just back tested. And so UDN, if you flip the dollar upside down, that's UDN. So that's a dollar in reverse. This is the inverse or dollar bearish fund. It's non-leverage, just it shorts the dollar. And what I was going to say is this is going to pretty much close to mirror FXE. So what we do is we go here. Let's go to this chart. Play a little game. SPY is the S&P 500. Let's do this. We'll look at UDN for you, which again is the inverse dollar. It's easier to see this correlation. If we were in a conference room setting or a classroom setting, I'd say, raise your hand. What were the biggest drops we've had in the stock market in recent years? And I think, if you follow this, and everyone knows, the S&P 500's in green. It was COVID, right? 36% in 6 weeks. And then we peaked in the beginning of 2022, and we went down into October right there. So those were, as everyone knows, the last two bear markets, if you want to use that technical definition of a drop of 20% or more, right? And so I'm just going to focus on those because this is really in this modern era. I could go back longer and you might not see this correlation as much because it didn't matter. Right now, we're in a different market than we've been in decades. We're in an inflationary environment, which we haven't seen the likes of since the 70s. So you're going back, 50 years, half a century. And so now when you're looking at things such as treasury bonds, interest rates matter a lot more than they did back then. A little uptick, 5 years ago didn't really mean anything because we were still historically at the low end of the range. Fed had a zero interest rate policy. Same thing with the currency. So what I'm going to show you here real quick, and this goes into our stock market analysis as well. So again, like I said earlier, you may have no desire to trade currencies, forex, the dollar, the euro, but if you trade both gold and silver and even the stock market, it very much matters. So what I was going to show you here is, remember we have SPY, the S&P 500 in green, and the inverse dollar. So when when this white line is going down, that means the dollar is actually rallying. Okay, so what happened here? Leading into COVID, which again may have been considered and will go down in the record books as a black swan event, the stock market was clearly pricing in the drop. We were short. We got in at the highs because it was clearly we had divergences, sell signals, everything else, and COVID just exacerbated that bear market. And so what you had is the stock market was going up, up, up. Everybody was bullish, but yet there was a red flag because the dollar was rallying. Again, this drop is UDN going down means the dollar's rallying. And so what happened? That divergence there gave us that. It preceded that. You say what you want, whether it was a cause, but you cannot argue stock market was going up while the dollar was rallying, and then boom, that hit. From there, you can see an almost perfectly correlation. In a normal, healthy environment, you can see the dollar's falling and the stock market's rallying along with it. And it's the same thing with gold. A falling dollar takes more dollars to buy an ounce of gold. And when the dollar's dropping, then it takes more dollars to buy a share of Apple, right? Especially if you're a foreigner or even in the US. So it tends to cause the stock market to go up. But then you can see right here what happened is the dollar bottomed, started to rally. Stock market ignored it, just like it was doing leading up to the big drop in the bear market when COVID hit. And then what happened? After it became clear that it wasn't a blip, that it was an actual downtrend, the dollar had reversed course, the stock market peaked. That's the beginning of 2020, and you got this, right? Then the correlation returned, as it normally is. This is where stocks bottomed. No coincidence, dollar peaked. You can see they move together, right? Everything. And look, even then, perfect correlation. Remember, I'm flipping the dollar upside down, so I'm showing you an inverse correlation as a positive correlation because it's easier on the eyes. Most people can see the positive correlation better. Okay, so what I wanted to get to here is we have not seen such stark divergence since leading up to the 36% bear market that came around the time of COVID, as well as the 2022 bear market. And so now, is this a timing indicator? No. Is it immutable or guaranteed that we're going to have a trend reversal? No. But history shows, especially in this current environment, something's going to give. And I just showed you a second ago. That's where I started out, and I probably got ahead of myself. Maybe should have showed you the correlation first. That we have the euro coming up on major resistance, meaning the dollar too, coming up on support. And so that's that. So, and it's not far from it. So if we reverse here and get rejected, anyway, something to watch and include into your analysis. Same thing with gold and silver as well, because here, I'll do it for you. Let's just, while we're here, while we're talking about it, EURUSD, we're comparing it to the stock market. So why don't we do, let's do UDN again. And let's turn that off, edit chart properties, and compare it to gold instead. And you can see too, there's the pretty good correlation, and you see a pretty big disconnect here between the two when they normally move together, these charts, especially in recent years. Okay, guys, so that's it. In summary, it's in my opinion no go right now on the adding any index shorts or equity shorts unless we move back down below 433 on QQQ. And whether you want to have it as direct plays or not, these commodities, agricultural, the grains in particular, still look bullish, both price action, technicals, everything else. and as does natural gas, and crude is probably going to pick up soon. Like I showed you some support levels there. Treasuries, obviously, if I had a strong conviction that they were going to continue up, I would not have closed that trade. Likewise, if I had a very strong conviction it was going to drop, I would have probably turned around and reversed it from long to short, which I didn't. So kind of standing aside that trade now, but I gave you some levels to watch. All right, that's it. I'll wrap it up here. We'll continue to hunt for individual trade ideas. Now that earnings season's out of the way, we can start, looking more to some individual stocks. We're still in earnings season, I'm sorry, but peak earnings is out. And remember, NVIDIA, the big one, NVIDIA is still a couple weeks out. And this right here will probably determine where the market goes. That's only going to be a couple more weeks now, May 22nd. That's going to be a big earnings report. All right, let me wrap it up here, get the video out to you guys. This has been Randy Finney with Right Side of the Chart. Have a great day.